Hi, friends. Welcome to the second part of the topic on leases or lease accounting. All right. So we're good enough. I think the first one worked. I had to just take it cautiously and check whether it has uploaded and whether it's working. And I think that's working. So I can now move on with the second part. Good. We are out. I'll try and then upload the others on taxation and then the IAS 37 provisions, then IAS 10 events after reporting date so that we can just get those ones out. All right. Okay, so good for now. Let's move on and continue from where we left off in terms of the lease accounting. Okay. So the second part of the lease accounting. All right. So I share my screen. I'm sure you can see it. I'm sure you can see it. Something is happening once again. All right. So let's see what we can do. Let's see what we can do. Okay. So we're dealing with lease accounting. Let me try once again. Something was not right. Something wasn't right. Okay. All right. I think it should work now. Good. Good. All right. So quickly, we went through the right of use of asset. Okay. And then we looked at the situation where we can discount and get the present value of the payments which are due. Right. And then we also proceeded and went ahead to look at what constitute the amount that we need to capitalize in terms of the right of use asset. We said let's include any initial cost of assembling, installation, and any estimated cost of dismantling as per the lease conditions. Okay. But we said for the purposes of financial reporting, we'll simply look at the fixed amount and any direct cost to assess the lease liability and then the right of use assets. Okay. We took this example, looked at how we can discount, and then we went ahead to post the transactions and show that you could even easily add a 3,000 here to this amount directly. Okay. And then you credit this to other legs. Okay. And then we also went on to say how do we measure this subsequently in the financial statements. Okay. When there are payments in terms of lease payments and how to recognize this. Then this is where I think we got to. There are two types. Sometimes we pay in advance, sometimes we pay in arrears in terms of payments of the leases. Okay. Now we got to this level, and I think we'll continue from here. Okay. So unless another model is designed, we always use the cost model when we are trying to um, recognize or measure the right of use asset in terms of its representation on the face of the financial statements. Again, remember it's an asset. So when you are presenting it on the face of the account, get rid of any accumulated depreciation or any impairment losses. Okay. Now, two things. If we will transfer the asset to the lessee at the end of the period, then try to depreciate it over the useful life of the asset. But if the ownership will not go to the lessee, then we have to choose one of two, either the shorter. So we're choosing the shorter of the lease term or the remaining useful life of the assets, the shorter of the two. Okay. All right. Now, if the asset has a low value, such that or the term is very low, the timeline, the useful life is short, 12 months or less, then at this point, what we say is that let's simplify our treatment because within that reporting year, we would have cleared everything, every transaction would have gone off. In this case, we are being told that we don't need to recognize any lease liability or right of use asset. Once a year, I'm just leasing this for a year or less than a year, we write everything off into the financial statement, okay? On a straight line basis, just cut it off, okay? All right. Now, the lease liability we said earlier is split into two, the current and the non-current. It is always easy to calculate the non-current element. Then the difference between the accumulated lease amount or lease liability and then the one we've calculated, the non-current, gives us the current component, okay, the current liability component, okay. So let's take an example and then we'll easily represent this, okay. Now, let's say on 1st April, and we are looking at 31st March. So within 1 year, SEMA entered into an agreement, a 4-year agreement, okay? And the asset itself has a 4-year useful life. Annually, we'll pay 215 and it will commence on 1st April. So payments in arrears at the start. Okay. The present value of the lease payment has been calculated is 750. We don't need to go and discount anything. Ignore discounting. And the rate is 10%. Okay. Ideally, we can just calculate for 1 year. We show the non-current and we show the current. But listen, I try to give you extra calculation so that you can just understand how the mechanics works. Okay. How the mechanics work. How the mechanics work. Okay. All right. So first of all, you can call it a lease amortization schedule, a lease liability table, whatever. Okay. So forget that. That's why I put this in the table, in the curve, in parentheses. Okay. All right. So at the beginning, year one, year two, year three, and year four, we were given 750 at the start. We pay off 215. The net is 535. Then we levy the 10% as a finance cost. This goes into what? Our statement of profit and loss. We know that, right? Then we add the remaining interest to the net amount and we get this as the closing balance. This closing balance becomes the opening balance here. Go on the same way. We paid 215. It's left to 373. Levy 10% on this. Okay, 10% on this. You get 37,350. Add it to the 373,500. You get this as a closing balance. This closing balance becomes the opening balance here. Go through the same way. All right. And you get this. This becomes the opening balance. Pay your 215 and it's left with something 3435. Normally, you will see after you have paid all your leases, or even if you go for a bank loan, they will tell you the term is 60 years, 60 months, okay? Or 5 years. You might think that, well, I'm paying, let's say, 52 every month. But at the end of the period, the bank will tell you there's an extra 27 you should pay. You will not understand why. It is because of this. We would have thought that after paying the 215, 215, 215, 215, it should knock off the total lease amount. But you see, there's a little of 478 that you pay to close it off. So normally when you see this, you can always ask for the schedule, the amortization schedule, and they will show it to you. Okay. Now at the end of the first year, we are looking at the first year. This is the finance cost. Okay. Now what we are expected to pay next year is a 215. This is a current liability. This is a current liability. So our closing balance, the closing balance of this figure, okay, minus what we are expected to pay, the 215, gives us what we are here to pay. That will cover the remaining 2 years. So this is the non-current, which we are here to pay, the non-current liability. And this is a current liability, which we represent. Okay, that's it. So in the financial year for 31st March 2018, we have our total. Okay, let's start with the income statement. So 750 over the useful life of 4. It means we get a depreciation charge of 187,500. And then the finance cost, which we calculated, also comes here, all under operating expenses. Okay, so that's it. We just subtract them. We deal with this on the statement of profit and loss. Okay. When we come to the statement of financial position, this is the asset, like any asset you can think of. Subtract your accumulated depreciation or any impairment losses, okay? So this is the net book value, which will represent, or the carrying amount of 562,500. Still, on the face of the extract on the statement of financial position, we have calculated the non-current component, which is 373, and that is payable over the remaining 2 years, the year 3 and year 4, okay? But for the year 2, we are expected to pay 215. That becomes the current liability. All right. Quite easy to understand. When you find this, you can always do it very easily. All right. Let's move on. Now let's take another example where we pay in arrears, not in advance. Okay, where we pay in arrears. So the first one was where we pay in advance because we pay the 215 in advance before we start payment. If I said arrears, that was a mistake. Okay, I admit. So we pay the amount right in advance before we even levy the interest. Now let's take the situation where we will have to first compute the interest on the amount before we pay in arrears. Okay, arrears is always later, advance is always earlier. All right. So let's take this case. Dynamic entered into a 3-year. Okay, payments are 10,000 for the first 2 years, 15,000. The same example we have looked at. All payments are at the end, arrears. Okay, present value of lease payment, we've calculated it, 31,552, but there was an initial cost of 3,000. Let's say their borrowing cost is 5%. Now, 1st January and to 31st December 2011, 1 year. Let's see how we can represent this and calculate this. Okay, so 31,552 is what we will recognize as the present value. Now there's an interest of 5%. Let's levy it, assuming all our calculations are correct here. Okay, 5% of this gives us this. That's the finance cost. Okay, then we pay 10,000. That's the annual payment. Balance is 23,130. Okay, 23,130. We get 23,130. Hopefully today my calculator will work because I have tried to reset it, and so calculator should not disappoint us unless something else goes out of place. But I'm sure the calculation is correct. So we get 23,130, okay, and then we levy the 0.05 on it, which gives us 1156.5. So that's correct, okay. And then we add this to this and subtract the 10,000, and we get 14,285, okay. So plus 23,130, okay. Then we subtract the 10, 1, 2, 3. So we end up getting 14,286.5. All right. So then this becomes our opening balance, okay. Apply your 5% on it, pay your amount, you go on, okay, on and on. All right. So in the first year, these are finance costs, right? And these that we are yet to pay for the remaining 2 years becomes our non-current component, non-current liability. Okay, knock it off, and you will see how much do we have to pay in the subsequent year. Is it not 10,000? But we will knock it off, and clearly you will see the difference between what is the balance at the end of the year and what is the balance that we are calculating to get our current component. All right. So the depreciation, as usual, should not just be the present value, but plus any intentional cost which is incurred in bringing the assets to its useful state. Okay, you know what it means in terms of calculating an asset. So we add in this 3,000, which was an intentional cost. We add it, and then the useful life over 3. Okay, this is the depreciation charge, 11,517. We have calculated the finance cost for year 1. Okay, now in terms of the property, again, it is these plus this, which we have looked at in the past. Subtract the depreciation and we get our carrying amount. Okay, we get our carrying amount. Now, in terms of year 1, the lease liability, the non-current component is this. But we were owing at the end of the year 23,130. 23,130. Subtract what we have assigned as a non-current, and we get a final component. And look at it carefully. When you are calculating and trying to find the current component of the lease liability and the non-current when you are dealing with arrears, payments is different. Payment in advance is different. Payment in advance, easily, we will detect that we have to pay this the next year. Okay. But in arrears, don't be tempted to think that we are expected to pay this. That will be wrong. Okay. The mechanics synchronizes with common sense and common logic. So you should be able to understand it. Okay. All right. We move on. What is done? I've done something wrong. Let's move on. Okay. So we move on. What if the transfer is a sale? What if the transfer is not a sale? Okay. Now make sure you tie it in. Okay. In order to be treated as a sale, that ties in with IFRS 15. We've looked at revenue from contracts with customers, and we know the 5-step model. Okay. But if at the end of the day, we are not passing the control to the person, what do we do? Okay, let's take a simple tabular representation. Okay, and then we'll look at it. If the transaction is not a sale, what do we do? If it's a sale, what do we do? Okay, if it's not a sale, treat it as a loan. If I still have given it out and I'm still using it, treat it as a loan. Okay, so here, if it is not a sale, continue to recognize it as an asset, but the amount you've gotten, recognize it as a financial liability, as a loan equal to the proceeds you receive. But if it is a sale, go on. You have sold an asset, they recognize it. Okay, and then recognize the right of use of asset as the proportion of the previous carrying amount that relates to the right retained. Okay, and then again recognize the lease liability at the fair value. We'll take an example and you see it. Then a profit and loss on disposal will arise. Okay. Now the right of use of asset is simply the lease liability, you find it in the question, divided by the sales proceeds, sales proceeds, times the carrying amount. Okay. We'll take an example and you better understand all these technical statements over there. Now, the profit and loss will simply be the balancing figure, but there is always a way you can always detect. You know how to tell where you've made a profit or loss. I've sold it, I've acquired it at a certain amount, I've sold it at a certain amount. Did I make a profit or a loss? Okay. Now, is again, like I said, it will be simply the profit or loss on disposal, the balancing figure after the sale proceeds have been debited to the bank. The asset has been derecognized and the right of use of assets and the lease liability have been recognized. Take a simple example and we'll understand. Okay, so on 1st January, Painting sold an item of machinery to Collage at the amount of what? 3 million. Okay, 3 million. Carrying amount in the books. So fair value on the books is 3 and we sold it for 1.2. Sorry, on the books is 1.2 and then we sold it for 3. Okay, roughly, let's put it that way. We are being told that it represents satisfaction of a performance obligation in line with IFRS 15. So we go on. Painting enters into a contract with Collage for the right to the use of the asset for the next 5 years. Annual payments 500 are due at the end of each year. Rate of interest 10%. Present value has been calculated of the lease payment 1.9. Remaining useful life is much greater than the lease. How much should we account for in terms of 1st January at the beginning? Okay, let's move on and see. So now remember, Painting must remove the amount from its financial statement. Why? And because it's an asset, it's a sale. It ties in with IFRS 15. Okay, so the amount will then have to split between the right of use, okay, right of use retained, and then the value which has been disposed. We sold it. We are still retaining some portion. Then we split the sales proceeds between the lease liability and the disposal proceeds. Okay. Now, part of the asset has been used, is being used. Part has been disposed. So we need to do that sensible allocation. Give the ones which have been retained, the ones which have been disposed of, give it to the one, and the one which you are keeping, recognize that portion. Okay. Now, these portions will calculate by comparing the sales proceeds received and the lease liability created. Okay. What did we receive? 3 million, right? Let's recognize the lease liability. That's the present value of payments of 1.9. So there's a balance of 1.1. This is actually the one we disposed of. Okay, you are retaining a portion of the property. You are using it, and that was 1.9. But you sold it for 3 million. It means you are keeping 1.9, and the 1.1 is actually gone. Okay, so we then split. We allocate the 1.2. The carrying amount on the face. We split it between the disposal and then the right of use. Okay, simple pro rata. So 1.9 over the total 3 times the carrying amount and 1.1 over the total times 1.2. So this is the disposal and this is what we are using. Okay, all right. Now let's go on with our calculation. Now the bank, how much did we receive? We got 3 million when we disposed it off. So that's what we do. We debit our bank because we received, okay, the proceeds, total sales proceeds, okay, the sales proceeds of 3 million. Now there is an asset component that we need to recognize of the carrying amount on the face of the account, which is 760. So recognize it. It's an asset. You are using it. You are using that portion. So actually, it is 760, which you recognize as your right of use of assets. Okay, this is the only technical area that you can think of. Now go on and credit. What is your lease liability? The present value of lease payments was given 1.9. Okay, on the face, remember the whole amount, the carrying amount was 1.2. We have to get rid of it. We credit machinery to get rid of it, right? 1.2. The difference will give you the profit. Okay, the difference will then give us the profit component. So simply, 760. Okay, less 1900 and less 200 gives us 660. Okay, so you sum this, we get what? 760. Subtract your 1900 and subtract your 200 gives us this profit. Okay, assuming, so you can see that the total of this exceeded this gives us a profit. Assuming that the total debit does not exceed the credit element, it's a loss. It's a loss. Okay, the same mechanics in terms of determining a profit and loss, where you are comparing the cost of the asset, talking of any accumulated depreciation, and considering the sales proceeds. The same mechanics here. You can also check and see what is the portion that goes to the sales proceeds. When we did the analysis here, 1.1 is actually the sales proceeds. And how much are we using? So the carrying amount, okay, the carrying amount would then, in the books, okay, we calculated the carrying amount, the one we disposed, this one, yes, 440. Okay, when we calculated the carrying amount from what we've actually disposed of, we get 660 is the profit. All right, that's all, friends. That's all. For further studies, I'll say take a look at the whole of chapter 12 of the text. Okay, there are more questions in the text you understand, and please look at them. And then I've put some questions already online, which deals with preparing the schedule. Okay, and then some simple calculations. I'll try and see if I can get um, additional ones from the exam kit as an additional question later on online for us to try and test. Okay. All right, at this point, I'll end here. And I think it is within, I was thinking we could get 15 minutes, but it's 22. But I think that's okay. All right. All right, friends, once again, this is a summary. You have to read more on your text. Take the text, examine it, try all the questions, and you'll be fine. Leases are very easy. You find it in an exams, 100%. Clear it. All right, friends, I'll see you. Take care. Bye for now.